Welcome to Ahead of the Curve. Subscribe now.
Welcome to Ahead of the Curve 1776. Long time no see, guys. Man, a lot has transpired over the last, I want to say, year and maybe a few months since the last time I did a video. I did remove all of my content off of the page because we're trying to get monetized here, so we're going to do it appropriately. So going forward, my videos will have a mixture of different things, be a little bit more interactive than they were before. I appreciate you guys joining me again to my 2,400 subs. Appreciate you guys. Also, check out the featured channels down at the bottom here. These guys have been keeping me abreast on what's going on in the financial markets outside of my day-to-day trading. I still have been engaged in that, guys, like you've never seen before. I'm doing everything from, Forex trading, options trading, crypto trading, energy trading, contract for differences that we talk about as well. Just everything under the sun, guys, I've still been engaged in that, as well as several other activities out of the market. If you're new to the channel, we talk about everything from economic data, monetary policy, politics, and market and trading strategies. Also, guys, I still got my links up here: Patreon, Robinhood, as well as Webull, as well as FX Choice for contract for differences or Forex trading, as well as EToro as well. So let's get to the markets and let's get to the money. So let's just cut on over to Forex Factory, guys. A lot has transpired. We have had 8 interest rate decisions. We have also had 4.25% increase on the Fed's fund rate, which is absolutely crazy to think about due to the amount of debt that we have. Just the debt payment alone would just be, a sight for, definitely making you feel some type of way because of, just monetarily how are we going to keep that going, and also fiscally. So, guys, it's just been a lot. We're in a restrictive policy stance. We had Jerome Powell speaking at the Senate Banking Committee this week, which I was engaged in and watching, observing. Basically hinting at that, their terminal rate, they're looking at 5 to 6%. Last time we went up this high was back in 07, 08. I think we got to like 5% there, and then we did pull back immediately. So we have an interest rate decision next week. I'm not gonna lie to you guys. I think this might be the last one. We have a lot of economic data that has yet to catch up to all the interest rate decisions, interest rate increases. So this is going to be huge. This next interest rate and what the guidance will be after that will be paramount. So as you guys can see here today, it was light overall on economic data today. And what I'll do is going forward, I'll probably at least do 2 videos a week on Wednesday. And then I'll also do a video on either Saturday or Sunday just to recap the entire week and also the week ahead. But today we had unemployment claims. We did see that tick up for the U.S. We also had a couple people speaking. And tonight, it's about 8 o'clock tonight here as I'm recording this, we do have the Bank of Japan releasing their interest rate decision. They have been negative 10% for the last 20 years or so for sure, as you guys can scroll down here and see. So it's been definitely quite a while. They basically have been dealing with deflation for like the last 30 years. Hence why they have negative rates there. But what'll be key is the monetary policy statement that we'll see going forward here. I'll get into that in my next video. But what I want to do is I want to kind of show you guys what transpired over the last week. So we had the Australian bank here. Let me go back here. The Australian bank here moved their rate up just a little bit, a little bit more restrictive than what it was before. But as you can see here, they're basically, for lack of a better phrase, the export-driven currency countries. So Australia, Australia, Canada, New Zealand, the heavy export countries, they typically are the first to start actually decreasing their rates, and typically the Eurozone, the US, and the UK, they started actually pulling back afterwards. So it's kind of a lag effect also on interest rate decisions. You typically will see them, the smaller countries actually push for the higher rates right away because they don't want to overheat due to everything that they do. And then the larger, more substantial economies, the trillions and trillions of dollars economies, they're a slow moving ship. So by the time they get to realizing what's going on, then that's when they pull back. So the smaller ones are just more agile and more, quick to respond to interest rate sensitivity, and the bigger economies do lag and take a little bit more time. But they definitely moved up there. We pretty much have seen everybody move up. I'm going to show you guys down here on the left hand side. New Zealand is 4.75, US 4.75, and like I said, typically Australia would actually be moved up a little bit more. The last time we were this high, we kind of had New Zealand and also Australia a little bit higher there. But they're definitely catching up there. But they are probably going to pause at this point. I think everybody is going to be in a big pause after this next interest rate decision. The Federal Reserve does lead this charge, since they're the ones who kind of, lack for a better phrase, started the game, other than the IMF, but they started the whole monetary system that we got going on here. So essentially, they're gonna follow suit. We're probably gonna pause after this interest rate decision just to see what happens, and for lack of a better phrase, see what breaks. It's gonna be huge. And let's scroll up here. Let's go back. We had, like I said, Jerome Powell testifying there. We had, Governor Lowe also spoke as well. We had the ADP that came out better than expected, the non-farm employment change there. And then we had the same thing with the Bank of Canada. They basically paused, and again, two things could happen next week. The Fed has such crazy data, such strong data come out the last couple of reports that maybe they will do a 50 basis point. I know that the Fed futures is probably at 50 basis points or 75 basis points, but in all actuality, maybe they will hold, because we do have a slew of layoffs. We do have a slew of housing data that's coming in, and also we got interest rates very high, guys. I mean, a lot of people are reporting that they could have 820 credit score, walking into a dealership and still getting an 8 to 10% APR, as well as mortgage rate sitting around 7%. You definitely have an inverted yield curve. We got the 2-year to 5-year, sitting at remarkable rates. So we definitely have a lot going on, guys. And I think, the Fed has done this, tightening cycle quite a few times. And, we are saddled with so much debt and we had so much stimulus that, maybe they're overdoing it. Maybe they're going to over tighten and possibly break something. And again, for anybody who's old enough to remember 07, 08, 09, it was a rough time. I mean, it definitely threw a lot of people for a loop, and we definitely don't want to, go back to that again. So as we've seen here, I was trading this yesterday, which was absolutely crazy. Markets are kind of, fighting what Jerome Powell was saying, as well as what the Bank of Canada did as far as their interest rate. So we basically had, the Canadian dollar getting weaker, as well as Jerome Powell testifying. So, there was a little bit of that going on. Plus, we have the JOLTS job opening, 10.82 million jobs. That is lower than where it's been before, but it's definitely holding its own, and revisions have been higher, 11.23, which is absolutely crazy. We got the 10-year bond auction, 3.99, 2.4 bid to cover, which is a little bit weaker. We've been seeing a lot of bond auctions be weaker despite the attractive yield there. So we'll definitely take a look at that. And then we also have Japan data, as you can see here, definitely falling off the cliff there. And whenever there is actual weakness amongst the G7, you're definitely going to see it exacerbated with the Japanese economy. So then we'll scroll down here on unemployment claims like we talked about, guys. We have that interest rate decision from the Bank of Japan. And then as you can see here, we got some heavy economic data coming out of the UK tomorrow, and then we will talk about that on Saturday or Sunday. And then we have the Canadian unemployment as well as the U.S. Employment situation. We're going to see probably unemployment rates stay about the same, which to me, this is a very moot indicator. A lot of people fall off of unemployment after 6 or 7 months or so. So this is very moot. I mean, this is more of a headliner more than actually substance there. But what we like to see is the average hourly earnings. Let's see if people are actually earning more money. And then let's see the employment change, which they got to lower there from what it was previously. So maybe they're just trying to lower the goalpost so we can get those great numbers so we can justify the Fed's interest rate decision next week being 50 basis points to 75 basis points. So all in all, guys, we do have a lot going on. We will talk further about those numbers. Now let's get you guys over to the Forex market. So since the last time we spoke, guys, we have seen the dollar get extremely strong. I mean, we were in the high 120s on the dollar index. You know, we pulled back quite a bit since that point because a lot of people, the markets were fighting against whether Jerome Powell is just jawboning compared to the actions. But the actions have met what he has said. He also, you know, likes to hint on, you know, Alan Greenspan, and basically Alan Greenspan had to, he was the Federal Reserve Chairman during the 70s. He had to get more monetarily tight in order to, you know, combat the inflation after we went off the gold standard. So at this point, guys, I definitely think we are definitely tightened up. And I definitely think that's going to push all of the U.S. dollar definitely stronger, especially at that next interest rate decision. Because what will typically happen is we'll get a risk-off appetite or risk-off aversion in the market to where basically people will start hoarding cash. They'll start hoarding cash. They'll start liquidating positions. They'll start buying treasuries. They'll start buying maybe real estate once it gets in a better position. So overall, guys, you'll start to see people start to owning hard assets and real things like cash and things of that nature. So we could possibly get to that. And basically what that means is just basically people are giving up on the game essentially for a time of period. So basically we'll see a small, I'm thinking maybe we'll have a decent pullback. The dollar will probably get even stronger from this point, even with the pause, because we'll start to see materially that the data is coming out. And if it's even with the pause and the data is still coming out strong, that means that we're not actually meeting that actual true terminal rate to be able to combat that inflation. So, you know, we have a lot of different ways to measure inflation: PCE, CPI, the U6, we have several different ways to actually measure that. The true way to measure it is to make sure that the federal funds rate is at par or higher. It should be higher than the actual interest rate. The inflation rate. So we know just from a rule of thumb that we're around 6-7% inflation rate from the last readings, and we're probably realistically maybe 10-15%. So we're always going to be behind the curve, pun intended, to make sure that to kind of combat inflation. So we definitely need to have rates push higher, but the saddle weight that's holding us down is the debt. We have so much debt that between personal, state, local, federal, we have too much debt to be able to pay that interest, and we are still a consumer-driven economy. So we do need to still keep spending, or else we will inevitably exacerbate the fact that we can't make these payments on the debt. So it's a catch-22, guys. I'm not sure how they're going to maneuver out of this. It'll be very interesting to see how they do it. But we will just actually take a look at the euro/US dollar. And we will go out on a reading here we'll just go out on a day chart here. And as you can see, we actually had a decent run up for the dollar. I mean, the dollar definitely got weak because, the market's running the assumption that, hey, this isn't going to be long term. We already got these interest rates baked into the cake, buy the rumor, sell the fact for the entire last quarter of last year. But what started to happen is, economic data still came out good, but we definitely did notice some weakening. And then here it is, the first quarter here, and we're almost wrapping up with it at the end of this month, and it's very considerable notice of weakness. And as you can see here, we have the U.S. dollar getting stronger, which means it's pulling back, almost trying to get to parity with the euro. It has done it before, obviously when it was initially traded, but it's definitely pulling back at parity there, and we'll see if it will get there. I do believe it will get there, even despite a pause in interest rates, just due to the fact that we're probably going to still have a slew of good economic news. I mean, unless something breaks and we're getting 1, 2, 3, $4 million, 1, 2, 3, 4 million unemployment claims a week, and housing market is collapsing, prices are falling substantially in a short period of time. I mean, unfortunately, we're always just going to be chasing that inflation tail. So essentially, numbers are going to look better. Retail sales will look better. They're pricing US dollars. So as things get higher in cost, may not actually be net more sales, but it might be net more dollars. So that can always confuse people as well. But as we're seeing that dollar getting stronger, because Jerome Powell over the last month or two is like, hey, we're getting serious about this. I know you guys are looking at the light at the end of the tunnel, but we have to keep going. And then they're basically saying that they're going to continue to do as much as they can do and will do. So that's very interesting to see that play out. So basically we're pulling back here, and if you go out a little farther here on the monthly chart, we basically slid off the cliff 2021, and then we kind of went down a little bit at the beginning of the year with the starting of the interest rate decisions. Again, we had 8, so pretty much each time we pulled back, we were under parity. I think we're definitely going to probably retest that, but I think long term, I think everybody knows this, long term, they will turn the monetary spigots back on, and we will be basically back to where we were before. I guess the difference will be, have we actually cooled off of inflation a lot, or are we basically just going to spin our wheels and basically do what we've done since the inception of fiat currency? Are we just going to inflate away the debt, inflate away, have the inflation tax instead of the actual real tax, and then we just continue to go from there? So we'll definitely check it out. I'll show you also the British pound versus the US dollar, and then we'll move on here. Same thing here, guys. Went out on a monthly chart. Again, guys, since the last time that I recorded was somewhere around maybe the beginning of 2021. And then basically we just slid for the cliff here. US dollar got extremely strong. It weighed on stocks tremendously. I mean, stocks literally had to pull back. I think they lost about like 20% on average. We had a little bit of a hope rally, right? A resurgence here, a hope rally. But I think that's going to be snuffed out here shortly, because if we go farther for another 50 basis points and then we have another meeting where they go up higher, I think their stop rate is going to be 5%. I don't think they're going to make it to 6% like Jerome Powell was saying in the Senate Banking Committee a couple days ago. I don't see that happening. I think we have too much debt, and for them to essentially go up, 1.5%, I just can't see it happening. It's just, at that point, we're already experiencing layoffs. I mean, look at this right here. We got 77,000, job cuts in February here. So, it is on the rise. And again, will the Fed, as everybody keeps talking about, will they actually effectively execute a soft landing? They can, if they are very, conscious on the data and stop looking so far into the future and start seeing it in real time, possibly. But we know the Fed. They only have they have blunt instruments. They have blunt tools that they use. Interest rates, the overnight lending, several different entities that they run in the Federal Reserve. So we'll have to see how things develop, guys. I mean, if you guys have been watching me for a while, you'll have to see how things develop. If I had to put my money, I am essentially a gambling man. I do trade for a living, so I would say probably the US dollar will get stronger. I mean, even from, and again, this isn't financial advice. Please do your due diligence and reach out to a licensed professional, but I probably see the British pound US dollar probably getting down to 110. If we keep up this bravado Alan Greenspan, possibly getting down to the 110 mark. If we have a pause, markets will see that as a sign of, accommodative stance, even though a pause could mean that we're just going to pause here, wait it out, and increase further. But we're talking about monetarily. So monetarily, a pause is, hey, we can still get this money cheaper and possibly make money in the future borrowing it. So that's how they view it. That's how the banks and institutions view it. They view it as the money is cheaper still now, even though it's expensive, but it's cheaper than it might be in the future, even with the pause. So markets will probably rally, the dollar will probably get weak. So going forward, we're probably going to just swing back and forth between a pause or an increase. If something breaks, guys, again, that is the wild card. If something breaks, then we'll probably have a decent pullback there. We'll definitely see probably the dollar break, because we'll have the slow incremental. Now, if something seriously breaks, they'll go back to what they did basically in 2020 and then just reverse course from, I think it was 2.25 down to, 0.25 less than. So we'll see if they do that. Could they? Absolutely. They've done it before. That was unprecedented, just for them to basically drop the rates. Could they this time? Absolutely. There's way too much debt, way too much economic deterioration for them possibly not to, guys. So it is definitely something to consider. Now, I am doing this video a little bit different than what I normally do. You guys know I do hit on the main bullet points as far as, the currencies, the metals, the energy, the cryptos, the stocks. But what I want to do is dive in a little bit deeper since I've been gone for so long. So I just want to give you guys my take on what's happening here. So let's go ahead and move over to the metals. Gold and silver, guys. I mean, if you guys have known, gold and silver, despite the strong U.S. dollar, it definitely had a resurgence here. I mean, they definitely just shot up. We'll take a look at the gold chart here on a daily chart here, and it just literally blew up. I mean, we had a nice little run up here, and again, that was that hopeism. The pause, right? We had a huge run up. I mean, we basically went from November 1650 all the way up to 1950. And again, that psychological level is about 2000. We were, I think, a little bit shy of that back in 2011, but, we're definitely probably not ever going to take that out, unless literally they drop rates, something breaks, and then we're just off to the races monetarily, as far as accommodative stance. So we'll definitely see. Now, again, guys, I'm long term. Again, this isn't financial advice. Do your due diligence. Please talk to a licensed professional. But we're probably heading back towards the 1800 mark for sure. Maybe even the 1750 as a low retest. Maybe a Fibonacci back and forth there. But unfortunately, guys, I just don't see it. I think we're too restrictive right now at this point in the game, and we still have a lot of good data coming out. So they may be reluctant to either pause. Maybe they'll call everyone's bluff and not pause, and they'll just keep raising rates until something does break. Because again, guys, their mandate is maximum employment and price stability. So right now they already checked off the maximum employment. It's already been achieved, 3.4%. Jobs, 10.82 million jobs posting. So they already got maximum, but now they need to control the price stability. So with that, they will have to sacrifice the jobs. And me watching the Senate Banking Committee, they were harping on the fact that we might have to lose jobs, which it happens. It happens. It is what it is. It's a part of the game. It's a part of the economic cycle. It's unfortunate, but in order to get things back under control and get back to that 2% target, which they are loving to try to do, I don't think that's ever going to happen again, just due to how much money is in circulation and how things go. I think more realistically is a 3 or 4%, even though that's astronomical. I mean, a lot of people would agree they don't want their money losing value by 3 or 4%, but that target would kind of be realistic compared to a 2%. I mean, economically, I don't think we'll ever be down to a 2% again. It's just too many things going on, too many bottlenecks, supply issues, geopolitical issues. I just don't see that happening. But gold definitely had a nice little run up there. Now we'll check out silver as well. Silver is pretty much at that $20 mark. It's been struggling here. I've been trading this for a little bit here. It's been struggling to get below that $20 mark. I think it will achieve it tomorrow, because I think the jobs number, they had the goalpost so low for the employment change that I think they're going to exceed that, and we're probably going to have this guy tomorrow morning trading at maybe 1950. We typically have big moves, after the employment situation. So we'll see the employment data change, and then typically if that's still rosy, then pretty much we're going to be off to the races, guys. We are going to get that 50 basis points next Wednesday, and we shall see, what the forward guidance looks like, as well as the the press conference, and see what we get from there, and also the monetary statement as well too. So again, guys, watch out for that. We're probably just going to be hovering about this for tonight, And gold and silver are the two monetary metals. Everything else is pretty much can be traded and stuff, but I only focus on gold and silver because they are the two monetary metals that the central banks really care about. So essentially, guys, I'm seeing the dollar getting pretty strong. The dollar index, we will get to that chart as well too, and I'll tell you what I think about that. But going forward, the dollar's really going to be king here. So you're going to see a lot of institutional people hoarding cash. A lot of stocks have also pulled back as well too. I think people are liquidating positions, just kind of maybe putting some capital to the side and see what happens. Now, guys, let's get you guys over to the energy market. I'm not going to lie, guys. WTI, Brent, natural gas, heating and oil, gas, US dollar. I really hope all of these definitely fall off a cliff. I mean, I think everybody is kind of over the $3 gas, $4 gas. Some people are, $4.50. Certain places in the country. I really hope this does fall off the cliff. We need to kind of see $2 gas because with the inflation and everything, I think this is one of the hugest costs that is not in the CPI. Food and energy is not in there, but this is a huge burden on a lot of people. So WTI, I can tell you guys what I think about this. Again, it's not financial advice. Please do your due diligence, but I mean, we're probably going to pull back here as well. Let's look at a daily chart here, guys. We had a little bit of back and forth here, consolidated periods, but then we'll come on a monthly chart here. We had that run up, guys, that we talked about, and then we basically pulled back a little bit, due to seasonality, but we did pull back a lot because that dollar was getting strong. And then for the first quarter here, as you can see, we're really pulling back. I think we could possibly, if we don't have any wild cards or anything geopolitically getting worse, if you guys know what I'm talking about, but probably pulling back to maybe the 60 mark. I would probably put as a first level of a support, maybe 60, just because, I mean, we could shave off a few dollars a day, and then you can definitely be at that 60 mark before the month is out. I mean, we basically, if we go on a month, 1 hour chart here, I mean, we basically pulled back $5 just over the last trading week, which is huge. I mean, we pulled back quite a bit, and $80 is kind of that roundabout psychological level. A lot of people like to hang their hat on. Then the resistance after that would probably be about $100, $90, and then resistance 2 would probably be about $100. But again, guys, at some point, we're going to see a pullback. The markets will believe the Fed, and the Fed will probably deliver. So you've got to anticipate that. We got to anticipate it either way. Even if they left rates the same, guys, there's so much that rate is so high that business will definitely slow down. So overall, we'll still get a deflationary, effect just due to the fact that dollars are not being spent. So we need dollars to be spent in order to justify the supply and demand economics of inflation going up. But again, guys, that's where I see it going. Definitely probably the 70 mark. We'll see how things develop, guys. We'll also see how that job numbers, that's probably going to, again, guys, I told you guys on my old videos, all of this stuff is priced in US dollars. So if the dollar is getting stronger, all the assets that are denominated in dollars will definitely do that as well too. So that's how I look at everything. So let's go on over to the cryptos market. We got a lot to talk about there. Cryptos, guys. Now, it was a weird situation today. I actually had a negative correlation today, just for today's trading. Overall, everybody knows, I mean, Bitcoin was like 70,000, a year ago. I mean, it was just phenomenal numbers, and then we just had that market realization that we had that huge sell-off, right? We currently have the Silvergate going on. You guys know about that. I think it was the FTX situation. So a lot of things are, and again, guys, as you know, I've always told you guys, this is speculative at best. Is it a medium of exchange? Yes, I told you guys that, a lot of people do use it as a medium of exchange. A store of value? Absolutely not. I mean, this is not a store of value, guys. I mean, this thing is not tied to anything. It's not tied to any central bank. It's not a stable. Most of these are not stable coins. So it is very arbitrary. Anything can happen with these guys. And then with Bitcoin, had a nice little resurgence here lately, guys. I've been watching it today. The dollar actually got weaker for today's trading day, 3.9, but the Bitcoin actually sold off quite a bit. I mean, as you guys can see here, we definitely sold off a lot. So I think a lot of people are exiting this guy and hoarding cash, which doesn't sound too bad. Again, this is denominated in US dollars, so if the dollar gets stronger, you're going to probably see a sell-off. So even though the dollar sold off, each asset class is its own trading instrument, so you got to watch out for that, okay? So let's take a look, guys, over here at the weekly chart here. As you guys can see here, this is the dollar index. We got the weekly chart kind of raised a little bit here. And then we also raised up quite a bit here. 6-month chart kind of falling down just a little bit here because we did actually see that what do you call that hopeism trading going on there. So it definitely decreased a little bit. Plus also we've seen a lot of people trying to end their portfolios off at the better part of the year. So we did kind of have a little bit of a pickup. But year to date, guys, we're pretty much almost on par because we're getting back to the situation of what happened pretty much earlier this year. Jerome Powell had to reiterate that he is getting serious. So from a year standpoint, as you guys can see here, we are definitely higher. And then if we go on a 5-year here, I mean, the highest we reached was that 113. So I definitely think we could probably retest that 110 for sure. We might peak out at 110. I don't know about the 113 unless we have a full market a risk-off situation like we did 07, 08. Definitely well possible. But I definitely don't see it getting quite that high because what most likely will happen is not just a stepping stone down for the interest rates, but probably a slide at some point after the pause. That's what I probably guess. But we'll go all time here. We had back in 85, 160 on the dollar index. That's just phenomenal to see, guys. We probably won't see that guy unless something crazy happens, right? Where risk off aversion is just happening. So we got 160 there. So all in all, guys, definitely probably pushing that dollar up, strong dollar. Let's get you guys now over to the stock market. Stocks sold off today, guys. Now, one remarkable thing, despite the interest rates raising 8 times in the last year and a half here, since I've been on at least, so pretty much the Dow has been relatively untouched. I mean, we've shaved off a little bit here. S&P as well and NASDAQ. I mean, it's just crazy how much the equity market just seems to be resilient. I mean, they're very resilient here. I think that has a lot to do with the portfolios of how everything looks. But yeah, I mean, it definitely looks crazy here. We go out on a 1 year. Let's go out on a 5 year. I mean, we touched 36,107, but we have barely shaved off like 10%, 10 to 15%. I would have thought after all these interest rate decisions, we're us getting almost back up to that 5 mark. I mean, if we go back here, let's just go back and let's see if it'll actually go back that far. Because the Dow was around like 10, 12,000 back then. But basically, we did have a huge pullback. I mean, we probably had like a 40, 50% pullback on that. Is it possible? Could we probably retest maybe the 22s, 23s? Yeah, I would imagine so. And look at this, Hong Kong stocks fall 2% as Asia continues Wall Street sell-off. So again, guys, Bank of Japan holds rates. Pretty sure they are going to reiterate or have that echo chamber of, hey, we're just going to hold rates steady. We're going to be data dependent, as they love to call it, right? And then they'll probably take it from there. But all in all, guys, definitely, you could get in the game, guys. I am a Forex trader. I am a futures trader. I am a options trader. And again, we'll head on over to the bar chart. I'll show you a few things. I'm just going to talk about bar chart a little bit, guys, to wrap up the video. But basically, bar chart in TradingView, which I'll show you at another time. But bar chart and TradingView are phenomenal websites to kind of gain a huge insight. It gives you so much on the page. I mean, you can literally see the stock market leaders. We typically see NASDAQ, Nvidia, and Apple. Basically, the NASDAQ, top people there. And then we also got Microsoft. Millions of shares being traded over the day. We had, Tesla really pulling back after that split. We definitely had a nice little, uptick in Tesla, but then we have a huge pullback, and I think it could probably get down to maybe like 150, honestly, especially after the interest rate decision and stock sell-off. So definitely be vigilant, be mindful, guys. If you're in these markets, definitely hoard a little bit of cash. Watch the other people that are on my page as well too, guys. Like I said, I'm kind of all over the place with how I do things, but I do appreciate you guys joining me. Please comment, like, share, subscribe, and as always, in order to be profitable, one must have the knowledge and insight about the next trade or position to. You guessed it, stay ahead of the curve, guys. I will talk to you guys very soon, most likely this weekend. Take care. Happy trading.